Iran conflict cuts off Gulf oil and chemicals trade. The Strait of Hormuz quickly became a choke point for energy and chemicals trade from the Middle East after the U.S. and Israel went to war with Iran. About a quarter of all seaborne oil and a fifth of liquefied natural gas has passed through this narrow passage between Iran and Oman in recent years. At its narrowest, it is 40 kilometers wide with maritime lane of about 4 kilometers, and the conflict has effectively closed it off to shipping. This halted exports of chemicals and hydrocarbons from Iran, Iraq, Kuwait, Bahrain, Saudi Arabia, the UAE, and Qatar. Shipments of nitrogen fertilizers also stopped, which in time could inflate food prices. About 12 to 14 million barrels a day of crude oil transits through the Strait of Hormuz, plus 4 million barrels of refined products, about 1 million barrels of LPG, 1 million barrels of naphtha, and 1.2 million barrels of jet and diesel fuels combined, says Eldon Gelder, a market analyst at Wood Mackenzie. Around 80% of oil shipped through the strait in 2025 was heading to Asia, with LPG and naphtha typically exported to Asia and liquid fuels to Europe. Oil prices tracked upwards along with precursor chemicals for plastics and other materials. Hundreds of tankers and container ships, many carrying liquid hydrocarbons and chemicals, are stuck in the Gulf either side of the strait. Asian chemical producers are especially vulnerable, with China more reliant on Middle East for feedstocks following recent trade disputes with the U.S. Asia uses naphtha to produce a lot of commodity chemicals that go into plastics, such as polyethylene, polypropylene, propylene, and ethylene glycol, said Joseph Chang. The Middle East also exports plastics and chemicals, including more than 12.5 million tons of polyethylene, 14 million tons of methanol, and 6.5 million tons of monoethylene glycol in 2025, much of it destined for China, wider Asia, and the EU. The market for MEG is structurally oversupplied, yet Middle East assets have a feedstock advantage and are running above 80% capacity on average. China is the largest consumer of MEG and could face critical shortages. Loss of Gulf MEG would also impact India, Indonesia, Pakistan, Vietnam, and Thailand. A report from Chemical Market Analytics predicts that Asian buyers will seek cargoes from the U.S. Gulf Coast, which may drive prices back up in an industry that had been struggling with oversupply and deep discounts. Some of Asia's other production plants make propylene and polypropylene from propane. There will be less propane available, and those prices will go up. This is really important. Approximately 15% of polyethylene and polypropylene production around the Persian Gulf will likely be disrupted. Over 30% of global trade volumes come from the Middle East. The volume is recoverable if other regions ramp up quickly, but supply chains will need time to adjust, so the potential for short-term volatility is very high, according to a Chemical Market Analytics report. With naphtha from the Gulf shut off, petrochemical producers will need to cut production or even shut their crackers, as feedstock are likely to dry up in about 4 weeks or less. Overcapacity has kept global operating rates at historical lows across many products, and it takes time to ramp up production or alter supply chains. We need to keep in mind that some producers outside the Middle East might not want to fill the gap until there is a price incentive to do so. For now, polymer production in the Persian Gulf continues, and there has been no damage to production sites. Given that the war could end quickly, producers elsewhere will tread carefully rather than going to the expense of opening facilities that they may not be needed. However, some Asian countries are already halting exports of some chemicals to retain supplies. European crackers will be hurt by higher feedstock prices. For a typical steam cracker in Europe, feedstock accounts for 70 to 80% of costs. That means European crackers will take a huge hit. European crackers may ramp up, but eventually they could be derailed by feedstock availability. Without Middle East exports, there's simply not enough hydrocarbon liquids to satisfy global demand. Gas prices quickly surged in Asia and Europe. Almost all of Qatar and UAE's LNG trade exits through the strait with no alternative route to market. Asia gets 90% of these exports, with just 10% going to Europe. European jet fuel prices spiked as the region depends on imports from the Middle East. Chemical producers that use gas for process heating also have reportedly begun adding fuel surcharges to existing contract prices for some chemicals in response to gas price spikes. I would assume in 10 days or 2 weeks, they would either start decreasing operating rates or starting declaring force majeure or even shut down operations. There are storage facilities for oil and gas, but less for chemicals, which are usually just exported directly. Wider economic impacts are expected. It is estimated that a quarter of nitrogen fertilizer is shipped through the Strait of Hormuz, with around 15 million tons exported each year as urea and ammonia. Food prices will start to rocket as fertilizer exports get hit. This is not just an oil, but a global economy story. There could be beneficiaries. The US and Canada could be big winners. North America has lower feedstock costs, giving an advantage to glycols, polymers, and other chemicals. An uncertain future, however, in the background of sustained oversupply means they could be reluctant to ramp up production. The war could be resolved quickly, or it could escalate. Initially, logistical difficulties were in focus, and there has not been sustained targeting of petrochemical plants. Nevertheless, on March 4th, Qatar Energy said it cannot fulfill gas contracts because of attacks on its facilities. Bahrain said on March 5th that a fire broke out at their refinery after an Iranian missile strike. And Kuwait, I think, just declared force majeure today. So, again, the U.S. is still going to win this because if everybody else is cut off, then everybody has to buy our stuff. And that's really the point of all of this.